Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. Well, it's tax time, so I'm starting to get a lot of questions about taxes and different issues pertaining to tax time. So I thought I'd share this show with some general tips and ideas and strategies for taxes, as I usually do this time of year. First, I wanted to talk to you about when you gather all your papers together and you look at everything getting ready to prepare your taxes. What I want you to do is think a little bit about and maybe do what I would call a pro forma tax return, which basically to me means a test run. And that means you go on, if you have tax software or if you're doing them yourselves, you run through, enter all the information exactly as you have it and exactly as it's come in, and see what your tax return looks like and what you owe or what you get as a refund. Then what I want you to do, I want you to look at different strategies and play around with it, not for the reason of changing this year's return necessarily, but also for what if I had done this differently last year? What if I had done this differently, let's say even 2 years ago, or do this differently this year? And the reason I want to do that is while you're in your taxes and doing them, I want to have you discover strategies and ideas to implement this year, even though it's too late for last year's taxes, that can positively affect next year's taxes. So let me give you an example of what I mean. Many of you have mutual fund statements and you receive 1099s. You'll see 1099s showing interest. You'll see 1099s showing capital gains, capital losses, and dividends. Now, you won't see interest on most of the 1099s from mutual funds, but you will from the banks. You'll see a 1099 DIV for dividends on the mutual funds typically, and you'll see a subcategory in those dividends. Normally, they'll say ordinary dividends and qualified dividends. And then you'll also, on the capital gains, see long-term capital gains, short-term capital gains, and you'll see those different breakdowns. Now, the reason I'm pointing that out is this. Sometimes you do things throughout the year that are totally unrelated to your investment statements, such as you sold your home, you sold a second home, you sold some other property for what will turn out to be a capital gain or a capital loss. I've talked about this in so many shows, but now at tax time, when I ask you to change your tax return around, what I want you to do is look and see, what if I had sold, remember I was thinking, you might say, of selling this one mutual fund near the end of the year. I didn't know what to do with the election. I didn't know what to do with taxes or interest rates. I was thinking, or the markets, I was thinking of selling this mutual fund. And you now have your statements and they show realized and unrealized capital gains and losses. So what I want you to do is just play around with it a little bit, not filing the return, and just look and see, what if I sold that mutual fund this year? Or I want you to see, what if I didn't sell the mutual funds that I did sell and waited until after January 1st to sell them? In other words, not recognize that capital gain or loss for last year, but push it off to January. You might see a huge difference in the income tax refund that you would have gotten this year. There are some strategies in there that we offset capital gains and losses and qualified dividends, etc. There are some strategies in there when we look at pro forma or alternative income tax returns based on different decisions we could have made or would have made and still can make for this following year. You'll begin to see why I keep saying around September and October of every year, you need to start doing income tax planning for that year. While there's still time at the end of the year to make changes and alterations on a pro forma tax return. What do I think the tax return will look like if I do nothing versus maybe I ought to sell that mutual fund, maybe I ought to buy this, this other one, or maybe I ought to wait until after January. Now, here's the problem with that strategy. It's limited in scope to one benefit, which is taxes. It completely ignores all of the other categories that you have to factor in when you make buy and sell decisions or any investment decisions. So here we come up with a great idea on taxes. You'd get an extra $1,000 refund, let's say. And then what happened? We didn't factor in market risk. We didn't factor in your long-term investment goals. We didn't factor in so many other issues, your Social Security, whether your Social Security would be taxed more from this or less. So we cannot just let taxes drive investment decisions. So I wanted to bring that up because it's a factor when we talk about taxes. But if you're talking to a tax professional only, or you're trying to do this yourself, you may make big mistakes in other areas you're not even aware of. So yes, we apply the strategies, but only as an exercise to see then whether it's worth pursuing further and looking at all ramifications of that decision and action or inaction, not just the taxes. Where are we in the markets? Where are you in time? What are your overall financial goals? The holdings that you have, do they fit ultimately in your overall financial goals, or are they a mismatch? And regardless of tax benefits, they should be rearranged into something else. And in that case, then we do tax planning. Should it be done in this tax year? Should it be done in next tax year? Which brings up another issue. What if one tax year you received a bonus or some inheritance that will be taxable to you, or something that is an anomaly, abnormal, not to repeat itself every year, but as a one-time event? Well, now we have to do tax planning, or at least some form of it if we're prudent, because we want to see, if I got an extra load of income this year due to a one-time event, should I take some tax losses from somewhere else to try to offset that? Well, tax losses only offset up to $3,000 in any one tax year of ordinary income. So I won't get into all of the detailed rules, but I will tell you, if you see one year you took a hit and have a large loss coming, don't wait till the end of the year when it's too late, or a large gain coming, get to your tax professionals and get to your investment professionals. Give us a call. I'll help guide you through some of the analysis of making good decisions, putting all those pieces together, and making the best decision, capitalizing on if there was an opportunity that you missed or will miss on should you have exercised some capital losses that you have elsewhere in your portfolio, or capital gains to offset losses, and do some strategic planning on the income taxes before it's too late. Now, at this point in time, it's after the first of the year, so it's too late for last year to do many things, you would think. And I'm here to tell you it's not too late to do everything. Your hands are not totally tied, where last year the books are closed, there's nothing more you can do. There are still things you can do. So one of the things that we look at first is when you see your income tax return, and again, this what I call pro forma income tax return, the one you do first, as everything stands right now, what will the ending result be? Refund, or do you owe? And then you look and you say, am I eligible to make a traditional IRA contribution, which is a deductible IRA contribution for most people, but not all? Am I eligible to make a Roth IRA contribution? Now, for your income tax return, the traditional IRA which is the deductible IRA, is the one that gives you the most benefit after the tax year already closed for last year on last year's income tax return. And here's why. Any contribution to a deductible IRA, which we call a traditional IRA, from January through April 15th, or tax filing time, actually whichever's earlier, is a tax-deductible contribution on the prior year's income, which means the prior year's income tax. So let me give you an example. You owe $500 last year's income tax. You already see it. You're ready to write the check. You owe $500. If you are in the 15% income tax bracket and you are under 50 years old, you are allowed to make, in many cases, not all, up to a $5,500, $5,500 contribution to an investment account or a savings account, IRA, classified as an IRA. If you make an IRA contribution, and I'll explain that a little more in a minute, up to $5,500, and you're in the 15% income tax bracket, that results in an almost $800 deduction on your income tax. It's a $5,500 deduction, but at 15% income tax rate, it actually results in about an $800 refund. So if you owed $500 and you now, after the fact now of December 31st, it's too late for last year, make a $5,500 contribution to a tax-deductible IRA, now you've generated an $800 refund against the $500 you owe. You get roughly $300 back instead of owing $500 just by making that contribution into your own retirement plan if you're eligible. The reason I bring that up is if you earn too much money and you're an active participant in your company's 401k plan, you may be ineligible to take the deduction for the IRA. We also have to be careful of alternative minimum tax for high income earners. But the main one we look at is the threshold or the phase out of being able to have a deduction for an IRA. Now, if you exceed the limit, you could still make an IRA contribution. So a lot of people say, am I ineligible to make a contribution? No, you're not. The problem is, are you ineligible to have a tax-deductible contribution? Maybe so. And that would mean it's a non-deductible contribution into an already existing IRA that you might have. Well, that's a nightmare, folks. So I'll tell you, I've read articles, I've seen the strategies on making tax-deductible contributions, not making tax-deductible, but in fact, non-deductible contributions is a backdoor method of getting into the IRA world. I understand those strategies, but please don't mix money on a non-deductible contribution into a deductible, otherwise deductible IRA. Yes, it's sophisticated, but I bring it up on the show to share with you. Look at all the options and opportunities I'm talking about. It's after the end of the year already. And here I am talking about things you could still do to affect last year's taxes positively for you. Now, if you're over age 50, you're eligible for an additional $1,000 catch-up contribution amount. So your maximum allowable contribution to a tax-deductible IRA might be as high as $6,500. Well, again, that's just almost $1,000 refund instantly, stroke of a pen. So if you were saving anyway, and you were putting money into anything, and you ask whatever institution you were going to, is it possible that I do that through an IRA instead of as I was normally doing it in a non-qualified account? It was just a regular account. If it's long term, that I don't need the money until after I retire, and that's the purpose for it, can I do the same investment or savings strategy with the same vehicles and make it an IRA instead so I get a tax deduction for it? Most institutions check what you're doing. The answer is yes, you could do it as an IRA or non-IRA. You just categorize the investments or the savings vehicles that you're using as IRA or non-IRA. And here now all the contributions you're putting in might qualify for tax deductions now. So that's step one. After the end of the year, there are still things you could do, and so can your spouse, to double the benefit of what I just said. Now, what about we get into planning stages and we say the same strategies that you're using for your savings? What if you say, I want to do a Roth IRA? I've heard all about these Roth IRAs. What I want to share with you is this. The drawback between getting the deduction now in a traditional IRA, like I just said, versus a Roth IRA is this. It's pay me now or pay me later on the tax benefits. The traditional IRA is pay me now on the tax benefits. I get the $1,000 refund now, the $800 refund now, so I don't owe the $500 I would have otherwise owed. I get a net $300 back. Life is good. That's a pay me now. But the IRS world is a pay me now or pay me later world. So any benefits you get now, typically, you will give up later. So we have to be careful here. Is it better for you to get the benefit now or later? In the 401k, it's almost always better to max out your 401k than it is to do a traditional IRA for a personal reason. But if you're highly sophisticated, I can't say that. The reason I say for a personal reason is this. When you enter into and become a participant in a 401k plan with your employer, you many times are eligible for the employer's matching contribution up to a certain percentage of whatever you're contributing. Well, that's instant free money. So that's a no-brainer. We take advantage of that, and any contribution to a regular 401k is income that will not count on this year's tax return, which is in essence just like a tax-deductible contribution. So that's a pay-me-now benefit on both the income tax and the employer match. The reason I say I want you to max out, in addition, beyond the employer's match, is it's convenient. It's payroll deduction. It's set it and forget it. So for personal reasons, I don't mean my personal reasons, but I mean human nature reasons, it's an autopilot, best scenario, way for little dollars to potentially build into big dollars on automatic pilot. So I normally recommend the 401k as an option for you to consider maxing out sometimes before we go and contribute to an IRA outside the 401k, even if you're eligible. Not always. Sometimes we don't. But the general rule is the 401k is so simple. Now, one of the drawbacks with some 401ks, it's a limited menu of investment choices versus the IRA world, you can go wherever you want. The problem with both, though, on the pay me now or pay me later plan is they paid you now the benefits, and when you withdraw money after retirement, let's say, for your income needs or for your retirement needs, all of the funds in that plan, including your contributions, since they were tax deductible when you made them, all of the funds inside that plan are taxed as you withdraw them. So they're not all taxed all up front, but they're taxed as you withdraw them. Up to age 59 and a half, there's an additional 10% excise penalty tax in addition to the normal income tax if you withdraw funds from an IRA or a 401k prior to attaining the age 59 and a half. So boy, they sting you hard on the back end. For the pay me now, pay me later plan is very expensive on the back end. It can ruin your Social Security planning because now all that additional income or your retirement assets, as you need to draw them for income, is taxable, which raises your income tax bracket in retirement, which raises potentially the amount of tax you'll pay on your Social Security. So you have to do sophisticated planning. Are you better off not getting benefits now and saving all your benefits for later? Folks, that's some of the decision making that we make at tax time for future purposes. Many people just look at the income taxes this year and their planning at tax time deals with only this tax time. But I and most financial planners actually will go out and look long term on the back end of these decisions we make today. And looking forward, see which provides you with the larger, greater, and most effective benefit in your planning, your long-term planning or your short-term planning. Guess which sometimes wins out? That's right. The long-term planning many times, most times, wins out over the short-term planning. That doesn't mean we don't take the tax deduction now, but it does mean the long-term planning helps confirm that that's the right decision if indeed that's the case. All right, folks, anybody who has any questions on looking at last year's tax return before you finally file, you want us to look at it, help look at your situation, see if there are additional strategies that can apply and benefit you before you actually file your final return, feel free to give us a call. I'll be glad to help sort through that with you, give you some time, and give you some good strategies before you file your final return. Thanks again for tuning in, folks, to another edition of All Things Financial. We'll be back again next week.
Securities and investment advisory services offered through SagePoint Financial Inc., member FINRA SIPC, and registered investment advisor. Insurance services offered through Driscoll Insurance and Financial Services Inc., which is not affiliated with SagePoint Financial Inc.